Hi, I'm Mike Knetter. Welcome to the UW Now Livestream series, where we bring you experts from the UW community talking about various aspects of the COVID-19 crisis. We have a great show for you tonight on the economy and the markets. I'll have three guests. First up, we have Brad Tank with us, who's a Wisconsin School of Business undergraduate and MBA grad from the storied Applied Securities Analysis program. And Brad is joining us on his anniversary. And we appreciate you doing that and Lisa's cooperation with this plan. Brad's had a fabulous career in the investments business. He's been a fixed income portfolio manager and a chief investment officer at various shops over the years, including Strong, Lehman, and then since 2007, I believe, Neuberger Berman Asset Management based in Manhattan. Brad is a highly regarded macro and monetary policy expert, in addition to being a fixed income manager, and he'll be focusing a bit on those issues for us tonight. Also with us is Ananth Seshadri. He's the department chairman and the Todd and Elizabeth Warnock Distinguished Professor of Economics at UW, where he's been for most all of his career. He's a prolific scholar in macroeconomics and public finance, and he's also the driving force behind our highly regarded economics department. He's a fantastic recruiter and really energetic guy, PhD from Rochester. And he's going to talk a little bit about the nature of the shock to the economy that was delivered by the COVID crisis, the policy response, and what the future might look like. And in addition, we also have with us tonight Noah Williams, who is the Julie Plant Granger Professor of Economics and the founding director of the Center for Research on the Wisconsin Economy here at UW. Noah happens to be a Wisconsin native. I guess that makes three of us on the show who are Wisconsin natives. How about that? Previously on the faculty at Princeton, and he earned his degrees at the University of Chicago. Noah studies macroeconomics, monetary economics, social insurance programs, and financial markets. So this is right in your wheelhouse, Noah. Why don't you take it away and give us your overview on things in the economy and some of the data that you've pulled together, in particular on how things look in Wisconsin. And then we'll hand it off to Ananth and then Brad, and then we will take audience questions as well. So without further ado, Noah, take it away.
Okay, great. Happy to be here. So I'm going to talk about some of the work that we've been doing in particular at the Center for Research on the Wisconsin Economy, or I'll just refer to it as CROW, that I direct and Ananth and some of my other colleagues are involved with. We've been really, over the last 2 months, basically since the crisis hit home here in Wisconsin, we've been tracking different economic indicators, trying to get a sense of what's going on in the economy with particular focus on activity here in the state. So we add and update this regularly. So if people are interested, you can go to our website, crow.wisc.edu, to get our latest. So we'll go to the next slide. I'll start with the headlines, the employment report, which came out on Friday. Of course, we all know that the primary effect of this COVID crisis has been on health, but the response to the crisis, both voluntary and due to government mandates, has led basically to a shutdown of large parts of the economy. And this really hit home in the employment report, which came out on Friday, where the official unemployment rate registered at 14.7%, which is the highest we've seen since the Great Depression, which was estimated a peak unemployment rate of about 25%. But in times like this, it's actually even difficult to measure truly what's going on in the labor market. So if you dig into the numbers were actually worse than that headline number. The headline number was 17.5 million people lost their jobs, but another 5 million people actually left the labor force, which means they're no longer employed, no longer looking for a job. So essentially stopped working as well. Moreover, the Bureau of Labor Statistics calculated that there was basically another 7.5 million people who probably just filled out the survey wrong, meaning they weren't at work, but they put down they weren't at work for other reasons. So if you add those all together, you actually get an unemployment rate on the order of 22%. So significantly higher than the headline rate, again, the highest we've seen in since the Great Depression. Of course, unemployment is a little bit different right now. The hope is that a lot of this job loss is temporary. There have been surveys that 70 to 75% of people on layoffs expect the layoffs to be temporary. But the longer this stretches on, the more that we're seeing these temporary layoffs become permanent. Moreover, as Ananth, I think we'll talk about a little bit later on, the unemployment doesn't mean deprivation as much for people right now because of the federal response. Nonetheless, we're seeing job loss on the scale and the speed that we've never seen before. Some sectors have been hit especially hard. The leisure and hospitality sector, which primarily consists of hotels and restaurants, lost 47% of all jobs in 1 month during the shutdown. But while these official statistics are informative, in some ways they're not really capturing the current situation because they are backward looking. The official unemployment rate was based on activity as of mid-April, so nearly a month ago now. Because things have been changing so rapidly and in such a large scale, it's been difficult to rely on the official statistics to try to get a sense of what's going on in the economy. So one of the things we've been doing at Crow is working with new data sources to try to figure out and try to track the economy with a particular focus on the state in closer to real time. And in particular, we now estimate that the unemployment rate in the state of Wisconsin is over 20%. And just remember where we came from. In March, our unemployment rate was 3.4%. So at the beginning of the month, we were at just over 3%, historically low unemployment, and we've gone up to over 20% now. Next slide. One of the things that we've been tracking to get this estimate of where we are now is the daily claims for people who are filing for unemployment insurance for the first time. And in the slide there, you can see the blue is daily data from 2020. The red are the corresponding figures from 2019. And what's shown there is date from essentially early March up until just last week. And what you can see is for the first part of the sample, the lines are right on top of each other. 2020 looks just like 2019. There's always turnover, people leaving jobs and so on. But then starting around March 15th, there's just a huge spike up in people filing for unemployment. We see the huge wave, which peaks actually in early April, when in one day, 25,000 people filed for unemployment. The numbers have come down since that time, but they still remain high. They're still roughly 10 times the level they were last year. Since hiring has also slowed substantially in most parts of the economy, this means that we're continuing to see increases in unemployment rates. So unemployment continues to trend up, even though the initial unemployment applications are coming in at a slightly lower rate. Next slide. So what's shown there is our estimate of the unemployment rate based on these initial unemployment claims. We now estimate that the unemployment rate is over 20%, like I said, up from 3% in March. This has been an incredible turnaround. Again, over the last 3 years, the number one complaint by most businesses was difficulty in finding available workers to fill jobs. So instead of having difficulty filling jobs, we're now having mass unemployment. Next slide. This is hitting the economy, hitting the state very differently, right? So we're seeing distributionally different sectors being hit harder than others. I talked about hotels and restaurants in particular. It's also having different regional impact around the state. So what we've done in the center is look at regional economic indicators. On the left is what we call a baseline economic index, basically a measure of how well were different counties doing before the crisis. So darker is worse there. So it means lower incomes, higher poverty rates, higher pre-existing unemployment rates. On the right panel is the increase in unemployment since the crisis really started around March 15th. And you can see that there's actually a pretty good correlation there, in particular across the northern parts of the state, which tended to be poorer, more rural, have also experienced proportionally more unemployment. The standout is the dark county in both figures, which is the smallest but also the poorest county in Wisconsin, which is Menominee County. It had a poverty rate of 26% as of last year. They've seen 27% of their labor force file, an additional 27% file for unemployment in the last 6 weeks. So this job loss is having differential impacts across the distribution, where lower paid sectors are facing higher unemployment. Also, poorer areas tend to be facing harder economic times. And again, this is consistent with what we often see in recessions. Recessions often hit the hardest on those who are least able, in some sense, to deal with the crisis. Next slide. One of the new data sets that we've been working with, again, to try to measure economic activity in real time, is using foot traffic from cell phones. So this is an anonymized sample. It's roughly 10% of the population in the state. So it's a fairly large sample. And what this data source does is it tracks activity, just basically visits to different retail locations around the state. So there's about 70,000 different locations. And again, we're tracking on the order of 600,000 people. So it's a fairly large sample. So what we see, what's shown here, again, there's a lot of lines, I'll just walk through it a little bit, is the ratio of visits between 2020 and 2019 from the 1st of March up until last week. And you can see for the first part, just focus on the black line, which is mostly in the middle. Things were roughly consistent. There'd been a little bit of growth year over year from 2019 to 2020, but then starting around March 15th, activity tails off dramatically. Throughout the month of April, we saw a decline in total activity on the order of about 52%. There's different sectors on there which have had differential impacts. Retail is the red, which is on top. That's seen more activity. That's largely driven by grocery stores and pharmacies. Grocery stores have actually seen increased sales. It's one of the few sectors in the economy that's actually doing well. On the bottom is information, which is mostly movie theaters. Movie theaters are shut down, so we're just not seeing any traffic there. If you do look over the past couple of weeks, there's been a slight increase. So we seem to have hit bottom, maybe recovering a little bit, but we're still down over 40% from last year. Again, this is just visits, just activity, people showing up at different locations. It doesn't measure transactions, doesn't measure sales. And moreover, a lot of work now is being done remotely. So if we plotted education sector there, visits to education would be way down. But of course, we've been teaching remotely up until last week, in fact. So if we account for the amount of work which is done at home, we get an estimate of GDP loss in the state on the order of about 30% year over year. So it's a huge decline in overall output, again, going even beyond what we've seen in unemployment. Next slide. And this just shows a couple of graphs just to illustrate how different sectors have fared. So instead of showing relative, this is actually 2 years. On the left panel is hotels. And so 2019 is the black. And it's daily data, so you can see there's spikes on weekends, people checking into hotels for the weekends. The red is 2020. And we see that activity really dropped off in hotels before anything else. I know me personally, once the crisis started, what was the first thing I did? Cancel travel plans, right? Cancel spring break, cancel any seminar visits and so on. So we saw travel really being hit first and hotels bearing the brunt of that. And you can see activity has remained very low. On the right is grocery stores. And grocery store activity, you can see, has remained high throughout the period. And there was an enormous spike in mid-March with the lockdowns. So the accommodation and leisure sector has fared the worst, but grocery store traffic has remained high. And in fact, sales have increased year over year, particularly with people not going to restaurants anymore. Next slide. I focused on Wisconsin, but Wisconsin is really roughly average for different states around the country. All states have been affected. The surprising thing is different states have imposed different levels of restrictions, but these seem to have had less impact than the overall voluntary reductions in activity. So what's shown on this graph or this slide are two graphs. We'll just focus on the top one, which is a measure of number of small businesses that are open. What's shown there are Iowa and Wisconsin, which basically line up on top of each other. Wisconsin had a statewide stay-at-home order. Iowa didn't, but there's really no difference in activity between the two. Michigan, on the other hand, has had both a stronger order but also a larger impact. So Michigan is the green line on the bottom. Again, Wisconsin and Iowa have seen a little bit of recovery, but activity is still down about 40%. Michigan is probably down about 50%. They've also seen more unemployment. So Michigan and Pennsylvania have been among the states which have been hardest hit in the whole country. Next slide. So this is what I was alluding to. We actually we put out a report in the center. One of our colleagues, Junji Go, tried to figure out what was the impact of the stay-at-home order in Wisconsin relative to people just voluntarily cutting back on economic activity. And what's shown here is a measure of people who are home all day. And you can see that it trends up basically starting in mid-March. The stay-at-home order didn't come in until March 25th. The solid line is Wisconsin. The dashed line is our best estimate of a control using other states around the country. And so there is a difference, after the red line there, you can see there is a gap that opens up between the solid line and the dashed line between Wisconsin and the control, but it's relatively small. It's only about 20% of the reduction in activity has been due to the order. The rest of it was mostly voluntary. And again, that's consistent with what we've seen with the states that have started reopening, Texas, Georgia. They're seeing a little bit of pickup, but not very much increased activity with their reduced restrictions. All right, and that's the end of my talk for now.
Fantastic. No, we'll come back to you with some questions. I'm particularly interested in the implications for opening, once the safer at home order leaves, if you have any thoughts about how quickly people come back. But sure. Thank you very much for that. Next, we'll bring in Ananth. By the way, I think that was our first instance of canine trolling that we've had on the show. I think I heard that in the background. Ananth, welcome, and give us your take on what's going on in this economy.
Sounds good. Thank you, Mike, for having me on the show, and a very warm welcome to all the Badger alums who have tuned in this evening. And so the way I want to think about this presentation is to lay out the way in which an economist, at least I, would view the kind of shocks that hit the economy, map out the effects that they've had. As Noah alluded to, a big chunk of the effects have happened voluntarily, not because of government lockdown or government orders. And then what the policy response was and what the impact of the policy. So first and foremost, COVID represents an extremely large shock to supply and demand. It's going to induce a recession as a consequence, the likes of which we've never seen. It's different from the types of recessions and the kinds of shocks we've seen in very many different ways. For starters, it's not a result of organic decisions that individuals made that resulted in this. It's an external shock. No one's to blame, and we got hit pretty bad. Big disruptions in terms of what firms could do, and consumers hunkered down because there was massive spikes in economic uncertainty. So one measure, for instance, of economic uncertainty would be the VIX index. And if you look at the movements in March, or if you looked at the number of days, for instance, in which the stock market went down by more than 2 or 2.5%, that month of March had bigger spikes than any other month in the last 120 years in the United States. So in the face of this uncertainty, which prevents us from going outside, prevents us from spending. It's kind of like they have this long period of a really bad storm that's hit, and we have to hunker down. We spend less, we consume less, and we don't go out to work. Next slide. So how COVID is different relative to every other shock we've had and every other recession we've had is this is a services-oriented recession. So in any typical recession, including the one that we saw between 2007 and 2009, the service sector tends to be acyclical, right? So by that I mean that even when the economy is down, the service output kind of goes up. Services cannot be stored. The demand remains strong. Demand for health services, demand for education, in fact, increases during recessions, right? But we had a retail sector that was already hurting. And what the pandemic does, it's only going to accelerate these trends. So one of the reasons we've seen lots of job losses, about half of employment was in services, and it's very labor-oriented, unlike, say, manufacturing. Okay, next slide, please. Something that Noah alluded to, we're seeing unemployment rates spike up to the levels that we haven't seen in a very long time. The unemployment rate is probably already somewhere between 15 and 20%. And one can only hope that we're not in a garden variety recession, because if it was, it's going to take a very long time, if the past was any guide, to get back to normalcy. Next slide, please. What COVID did was it induced a reallocation of labor. There have been tremendous job losses. 33 million Americans have filed for unemployment insurance claims. But for every 10 layoffs you've seen due to COVID, 3 new workers have been hired. So you might have been in the hospitality industry or working at a restaurant and you're laid off, and then you get hired by Papa John's or Domino's or Amazon or Walmart. So what the pandemic did is to increase demand at certain firms, larger firms, bigger chains. And this shift in spending patterns and business practices are possibly and likely going to persist for a while. Next slide. So what are the short-run economic impacts associated with COVID? A measure that economists love to look at is consumption as a measure of well-being. Consumption started to fall pretty early on, well before we had like lockdown orders, stay-in-place orders. So if you look at consumption now versus what it was, aggregate consumption now versus what it was, say in February, we're down 20%. Now that's a massive, massive fall for a 2 or 3 month horizon. The one category, unsurprisingly, that did rise is expenses and groceries, that between February and now has gone up by about 20%. Next slide, please. Employment, if you look at employment and arrange them by firm size, and you ask the question, did employment fall more for smaller firms or larger firms? Employment ended up falling a lot more for small businesses than larger businesses. So if you're in a business that on average employs 1 to 9 or 10 to 19 employees, you're seeing 30% drops in employment, as opposed to if you're in a bigger firm, some bigger firms have actually increased employment. But on average, the bigger firms see drops of more like 10%. So this is an important structural change. It's been happening for a while, and you're going to see the movement towards bigger businesses. And here's just an example of what's happened at Amazon and Walmart. Amazon's been doing really well with incredible increases relative to the same time last year, but so has Walmart. Next slide. So what was the policy response to COVID? So the shock hit the economy. And there was a lot of uncertainty surrounding the shock. We didn't have a whole lot of data at that time. We didn't have the knowledge of the experiences of other countries that have gone through the crises, which we do have at this point. So the way I thought about how policy responded was, it's almost as if we turned the lights off sometime in February or March, with the hope that we want to turn it back on in a few months, right? So the first one, next slide, please. So the first response was the CARES Act, and this was Congress's response. So the first important component was a cash payment to low-income individuals. So if you're below a certain income threshold, you get $1,200 a month. And there's extra unemployment benefits. So it not just gave you an extra $600 weekly, but it also extended the duration of unemployment benefits. There was something called the Paycheck Protection Program, which had this element of what I was describing earlier. These were emergency grants and a associated forgivable loan program for companies that had 500 employees or fewer. And so the idea there was, if you spent more than 75%, at least 75% of this grant, of this loan, on essentially employee compensation, on wages for employees, then that would become a forgivable loan after a period of time. And there were also $500 billion in loans for big corporations, which also included like $58 billion for airlines. Next slide, please. So in addition to Congress's response, the Federal Reserve has intervened in an unprecedented way. So there were large instantaneous cuts to the interest rate, along with a commitment to maintain low interest rates for a period of time. In addition, the Fed engaged in an extensive asset purchasing program. The Fed gave out about $4 trillion in loans, helping businesses, states, and local governments. And this was an incredible expansion of the Federal Reserve's purview. So about a decade ago, the Fed would buy T-bills and treasuries, as well as mortgage-backed securities with the backing of the federal government. Now the Fed's in the business of giving aid to firms and governments at the risk of defaulting, and small businesses as well. And the basic idea is to be a lender of last resort and to ensure that there is no liquidity crisis. If you want a loan, especially a short-term loan, you have it. If the impact associated with COVID persists, we may well have a solvency crisis. So the one entity, interestingly, that does not have access to capital markets is UW-Madison. Given I'm talking to Badger alums, I thought I'd make this point. UW-Madison is the only major research university without direct access to capital markets. So for instance, if you're Indiana, you could go to your board of trustees and get a line of credit for about $1 billion and try to smooth your expenses over time rather than having to take a big hit. Right now, you could take a loan at extremely low interest rates and make use of these credit markets to smooth your expenses and not have program cuts and closures and layoffs. Amazingly and remarkably, UW-Madison is the only major research school which can do that directly. And I'm sure if we have the ability to issue bonds, we'd get the highest credit rate. Next slide, please. So what were the effects of the policy responses to COVID? I'm just going to have 2 slides and then I'll end. So the first one is what happens to consumption. So there were these cash payments that were given to individuals. And here, we've arranged the data based on liquidity. That is the amount of bank balance that individuals have. So unsurprising, and what I'm going to plot here is what economists would refer to as the marginal propensity to consume. So if you're given $1, how much of that dollar are you actually spending? And for very low income individuals who have a balance of less than $500 in their bank account, the answer is about 33 cents to 34 cents on the dollar in 10 days. So for really low income and low liquidity individuals, this had a very big impact. And as you go up the income distribution, as you go to people with more liquidity, unsurprisingly, it had very little impact. And this is something that's going to be useful for policymakers to think about as they design the next package and to make sure it's more targeted. Next slide, please. So lastly, I asked the following question, which is, did the Paycheck Protection Program, the intent of which is to help firms in states that were influenced the most actually hit the target? So on the x-axis, I'm going to plot the fraction of businesses that receive PPP in a particular state. And so you look at North Dakota, Nebraska on the right, and those are states that actually a big fraction of businesses received money through the Paycheck Protection Program. On the very left, you see states like New York and DC that didn't quite benefit as much from the Paycheck Protection Program. So what you see is actually on the y-axis is some measure of how badly or how poorly the state was affected. So what you actually see is a negative correlation. So the states that were actually affected the most, like New York, DC, California, Nevada, actually had very few businesses receiving PPP. So at least if the intent of the program was to aid more businesses in states that were affected most, it didn't quite hit the mark. I'll stop here and we'll be happy to take your questions as they come. Thank you.
Great overview, Ananth. Thank you for that tour through all the policy measures as well. Next, we'll turn to Brad Tank, and Brad will share a little bit about his thoughts on the economy, with a little more emphasis perhaps on the financial markets, which is his domain. So Brad, welcome.
Sure, thank you, great to be here. As Mike said, I'll hit on central banks and the economy, but then turn to markets and then finish on the topic of regime change. In other words, what's likely to have changed permanently as we come out of this, both in markets and in terms of behavior and economics. So building on some of the comments that Ananth mentioned in terms of central bank response, what we did see in March was unprecedented response, not only from the central bank here in the United States, but from central banks around the world, Bank of England, European Central Bank, Bank of Japan. The setup for the liquidity crisis that emerged in March really had its roots in the re-regulation process that occurred after the great financial crisis. One of the biggest changes that took place is in an effort to keep the banks safe. Investment banks and commercial banks really can't use their balance sheets to act as a buffer when many market participants want to sell. They can't position securities. They have to match buyers with sellers. And so what we saw was a violent price discovery process in March, which prompted a very rapid and massive response from these central banks, including 2 special meetings in the month of March from the Fed, meetings over the weekend, actions over the weekend, and to a large extent, their work in terms of having liquidity return to the markets has been very, very successful. They started in the treasury markets, but then, as Ananth mentioned, moved on to municipal bonds, commercial paper, repo markets, municipal, and then even exchange traded funds. They're entering that market this week as we meet here today. There's more details being laid out on that program. So appropriate and massive. The good news is post great financial crisis, they had a playbook. That playbook in the GFC was built over the course of about 18 months. The recession that accompanied the financial crisis was a 6-quarter recession. They used that playbook in a matter of weeks, and then they went beyond it, well beyond it. And if Ben Bernanke was the right central bank chairman for the great financial crisis, because he literally wrote a book on unconventional monetary policy response to financial crisis, never thinking he actually have to apply it when he was Fed chairman. Chairman Powell's trained as a lawyer. And one thing that we've observed here as the Fed's aggressively pursued maintaining liquidity in the markets is they've really pushed the boundaries of what they legally can do. Nobody's complaining. They've been fully supported by Congress and the administration, and they are working jointly with the Treasury to support not only large businesses and markets, but small businesses and consumers. And it is having a very positive effect. We've seen a meaningful bounce in financial markets very much across the board, some places more than others. In terms of the economy, Noah focused on the impact in Wisconsin, which has been severe. Much of the country looks very much the same way. The way that it will probably shape up as we move forward is the worst quarter will be the current quarter, when on an annualized basis, we'd expect the U.S. economy to contract by about 30 to 35%. Q3 hopefully can witness an emergence to a growth pattern beginning. But even as we finish the year, based on the severity of the decline, we're probably looking at a U.S. economy that's about 5 or 6% smaller in aggregate in 2020 than it was in 2019. Our forecast at Neuberger Berman has the recovery continuing into 2021 and probably takes until about 2022 to get the U.S. economy back to where it was when it finished up in Q4 of 2019. That's a presumption that we continue to see good policy decisions made both on the part of central banks and governments, and we generally have, not only in the U.S., but in many places around the world, including developing economies, emerging economies, which are very vulnerable, of course, to this virus. And also that we continue to see some good progress and hopefully some positive surprises on the public health and medical front. But lots of uncertainty remains. Mike asked me the question, setting up for this evening, what's the stock market doing up here? We've seen a big bounce in the stock market. I think today was the first down day, second down day out of 7 for NASDAQ. So we've seen more green days than red after a March that was all red and early April that was all red. And the short answer to that is, if you look at the S&P 500, it's not the U.S. economy. It's big companies. Building out what Ananth said, there's been a big rotation within businesses. A lot of the success stories in the large company space have been in technology and healthcare. About 1/5 of the S&P 500 is doing well, enough to drive the averages higher off the bottoms, but about 4/5, most of the stocks, the smaller stocks in particular, aren't doing so well. So while the S&P is down about 10% on the year, which is a remarkable performance against what will be the biggest contraction in economic activity here since the Great Depression, small cap stocks, which are more representative of the U.S. economy broadly, are still down about 26%. And then if you look at other parts of the capital markets, the high yield markets down about 10%, emerging markets down substantially as well, both in debt and equity space, mid-cap stocks down about 20%. So we've seen recovery in all of those areas, but not to the extent that we've seen it in large stocks. I mentioned some of the things about this crisis that are different than the GFC. Continuing on that topic, the GFC, as I mentioned, 6-quarter recession. This is hopefully a 2-quarter recession, worst case 3-quarter recession. So the speed of the drop, unprecedented. Likewise, the recovery should be quite sharp as well, although you've heard terms bandied about over the course of the last month or two: V-shaped recovery, U-shaped recovery, L-shaped recovery, which is basically no recovery. You just go down and flatline. Our general thesis is that it'll be a bit more of a U-shape, and ultimately things will get back to very much like they were in 2019. The real question is what comes next? Well, again, in contrast to the GFC, one of the good things coming out of this financial crisis and this pandemic is that we know what central bank policy is going to be. Remember, back after the GFC, central banks around the world were struggling to set policy coming out of that. Some policy mistakes were made. The European Central Bank, for example, prematurely feared inflation and started to raise rates, really crippled the recovery in Europe, and it took them a couple of years to catch up. And things were really starting to look up just a few years ago in the Eurozone, and now they're back struggling along with the rest of the economy, and the central bank continues to be challenged. But coming out of this crisis, we know that short-term interest rates are going to be zero for a long time. That means that when we come out of this, the hunt for income in capital markets, whether it be dividends or bond income, is going to be relentless. That'll help companies continue to finance. Again, unlike the great financial crisis, the borrowing opportunities, whether it be at the banks or in the markets, have been wide open for companies. We've seen record corporate bond issuance in the month of March, in the month of April, and we'd expect it again in May. At times in the financial crisis, there was little to no corporate bond issuance. So markets were effectively shut down and companies could not borrow. Banks, likewise, were in the middle of the financial crisis. They were part of the problem. They were a big part of the problem. This time around, banks are part of the solution. They're administering many of these programs as it relates to the CARE Act. They're working in tandem with the Treasury and the Fed, and they're in generally healthy shape. We don't have bank failures to worry about, which was obviously a big concern in the GFC. So that leaves with the final question, of regime change. And regime change happens. It happens in markets. Often it's only visible through the rearview mirror. The way that we describe this one is it's visible through the windshield. It all happened pretty darn fast. When we think about regime shifts in markets, going back over the last 20 or 30 years, we had a regime shift from the 80s to the 90s, from a value-driven market in the 80s, built around the buyout culture and the realization of latent value in equity markets, to a tech-driven market in the 90s, which ultimately culminated in a tech stock bubble, and then a transition in the 2000s to a consumer-led recovery, where mortgage finance ultimately yielded another bubble. But coming out of this one, there's a few things that many have speculated. I'll hit on just a few that we think are credible in terms of what changes permanently. Work from home is going to remain in place. At my company, at Neuberger Berman, we've got 2,100 people. 99% of us are all working from home. Some of us actually like it. Some of us don't. Some do well with it. Some don't. But as we think about the future, we've already laid plans that the amount of real estate we will occupy going forward will be smaller, and many other companies will do the same. Urbanization probably reverses a bit. Millennials had started to reverse the urbanization process by moving to smaller towns and areas that have all the benefits of big cities without some of the costs. We think that trend likely gets exaggerated. The good news is post-GFC, savings rates have gone up and stayed up. They are likely to remain up. Not great for consumption, but people are going to want to have fatter wallets and bigger savings accounts based on what we're going through right now. There'll also be some adverse demographic consequences. Probably be a bit of a baby dearth, at least for some period of time, until people regain confidence in the future. And likewise, tax policies are going to likely change. Somebody's going to have to pay for all of this at some point in time, and it's probably capital that pays for it, not labor. So we won't be seeing any more corporate tax cuts. If anything, the last round will be reversed. So with that, I'll finish on a anecdote about monetary policy, because I think that from a policy-making standpoint, Ananth went through a whole host of programs that have been put in place. It's been very, very good. Central bankers have done a good job. Treasury and administration and Congress here in the U.S. have done a good job. There's more to come. They will continue to support the economy as best as they can. In the aftermath of the GFC, a couple of years later, I had the opportunity to interview Ben Bernanke at a conference, and I finished my interview with him by saying that, Chairman, I grew up as a Packer fan, and he looked at me like, where is this guy going with this Packer fan thing? And I said, well, I grew up as a Packer fan, but I never got a chance to meet Vince Lombardi. And after what you did in the GFC, I'm glad I actually get to meet you. So he got the anecdote, and let's just knock on wood and hope that Washington and the central banks and our peers over in Europe, Japan, Asia continue to do a good job, because lots of support from governments and central banks is going to be needed to get through all of this.
Great remarks. Thank you, Brad. I'm going to stay with you for a minute, if I might. I got to correct one thing. I heard there's going to be a baby boom like in January and February because of the lockdowns. Anyway, we don't have to talk about that. I do want to follow up about the stock market. Stock markets, as you note, it's not the economy, first of all. And of course, they're very forward looking, so they usually lead the way out of problems. Why did it take so long for the market to understand the significance of the COVID crisis? I look back on this and I wonder myself, like, what was I thinking? I gave a presentation in Milwaukee in January, and one of the audience members said, do you think the coronavirus could cause a recession in the US economy? And I thought, wow, I have no idea. I just didn't know at that time how far the virus would spread, how fast, but it seemed to be a very sudden realization that it was here. And, why did that take so long? Any ideas?
Yeah, I think it had to do with the very constructive backdrop that we came into 2020 with. We were ending 2019 with what was very clearly the end of a downturn in the global manufacturing cycle. So you saw big manufacturing economies in Europe like Germany, and Asia like South Korea turning up sharply. So some of the pessimism that hit us in late 18 and early 19 about global growth was really going away. Some of the anxiety around global trade, with phase one of U.S.-China trade deal, that was inked. You also had a central bank here in the form of the U.S. that was engaged in re-injecting liquidity in the markets more for technical reasons than out of absolute economic necessity. But clearly the U.S. central bank had become much more supportive. And you had big positive knock-on effects in the developing world. The emerging market economies have been through a few hiccups in 2017, 2018, 2019. And again, with the developed markets manufacturing turning up, it looked like things were going to be great in emerging markets as well. So that's how we came into 2020 with really benign inflation, cooperative central banks, and what appeared to be the early stages of the boom. No excesses. Consumers were in great shape. It will pave the way ultimately for recovery, particularly here in the U.S., where U.S. consumers generally been cautious post GFC. You don't see excessive leverage. You've seen a sharp response to what's happened, but I think those are reasons. The fact that things were so good and the markets were slow to react sets the stage ultimately for recovery.
Great. I'm going to go to Ananth with a question that's been bothering me. So Ananth, Brad mentioned, this stimulus is going to leave us with a bill to pay at some point. And of course, I know a lot of people are starting to wonder whether, when all central banks act in concert the way they are and sort of monetize in effect by growing their balance sheets on the order of the size of the stimulus, is that a bill that ever has to be paid? I mean, it does in some sense, I think, increase potential demand beyond what our supply is generating in income, but I don't know when that'll be realized. Does that make any sense? I mean, is there some sense in which when we all do it together, we can kick that can down the road somehow?
Yeah, it's an interesting question. This is a bit different from the financial crisis, where that was a crisis, the global financial crisis. At some level, we exported to the rest of the world. Right? We were hurting. The rest of the world was not as much as we were, and we could borrow from them. At some level, the bigger question with, say, the CARES Act, which has not been paid for, or even the tax cuts from 2 years ago that was not paid for, or even the war from 2003 that was not quite paid for, which has been piling on kind of debt and deficits. So one way to ask the question is, can we take on more debt? Are we going to be faced with an economy with higher interest rates, right? So something that's gone on in the US economy and the world economy is that interest rates have been getting lower and lower, the long-term equilibrium interest rates. So long as the long-term real interest rates stay low, the debt problem is really a choice for the United States as to when we want to pay it back. Do we want to pay it back now? Do we want to pay it back over a period of time? You're at war, kind of like we were in 1944, right? So we took on big debts at that time. The U.S. debt to GDP ratio went to in excess of 100% relative to GDP, and we paid it off over a period of time. So at some level, I think really it's the choice for us as to when do we want to repay, when taxes are going to go up.
Okay. So I'm going to stay with you. Alan wants to know, why are we the only major research university without access to credit markets? I mean,
that is a great question, and I was actually going to pose that as a question. To me, it sounds as if the issue of bonding authority was also intertwined with the issue of public authority, right? So an institution that has kind of freedom at some level, kind of like UW Hospitals, has the ability to issue bonds on its own because its own separate identity, as opposed to, say, being attached to the system and in turn being attached to the state. And that's probably the best answer I can give.
But I guess other universities can do it, and some of them are public too. So to be continued, I guess we'll have to go somewhere else to get that question answered.
Yeah.
Noah, I want to go to you, and I want to ask you, that data that shows, really people's behavior was out ahead of the shutdown orders or safer at home orders, whatever they're called. Will it be the same when those are lifted? In other words, do you think at the margin we're only damping down 20%, or do you think we're at a point where now the safer at home is biting a little harder because people feel like they want to be out more?
So the best estimate probably is if we were to remove it immediately, we would see a bit of a rebound, but it would be basically like we'd go back to where we were in early March, where I think people know more now and are probably more cautious or have a better sense of how to behave in the current situation. But I certainly wouldn't expect a rapid rebound, like, say, if we were to remove the order tomorrow. There's a real asymmetry. People are quick to cut back and very slow to resume activity. So I think it'll really take a while before people, get comfortable going back out and resuming daily life.
So Ananth, the grocery consumption way up. What's going on there? Are we all eating our way through the pandemic, or is it the hoarding behavior that's driving that?
I mean, the hoarding behavior, you saw that right after people process the information associated with COVID, right? Like buying toilet paper and other groceries, and so on.
That makes sense if they're buying more groceries. I don't know.
Absolutely. And if you're not using the toilet paper at work, it's got to be some kind of a substitute back at home. But the other aspect is it's just a substitution of food towards home from food away from home. So people are not eating outside; they're cooking from scratch, and those have a pretty big impact on grocery purchases.
I'm a little worried with a lot of these shutdowns of production facilities in the food industry as restaurants now open up and they start to draw in more demand. You just start to wonder if there's enough inventory out there because, they probably haven't been carrying as much inventory while they're, in this shutdown state. consumers have hoarded a bunch. It could get a little bit dicey during the grilling season here.
I can't speak to that, given I'm a vegetarian.
Brad, I think you must be worried about that. Don't you have something in the smoker for your anniversary dinner?
The smoker's operating right now. It'll be done in about 2 hours. So I'm on Pacific time, so I'm pre-dinner time right now. But yeah, always concerned that I can always head north into Wisconsin come fall and take care of that myself.
So I got to ask all three of you for a prediction. How long will it take for us to get back to 5% unemployment, Brad?
Yeah, I think it's a reasonable objective, but it's one that we probably won't realize until we get out to 2022. I think we will see a pretty good recovery between now and the end of the year, but then because of these big transitions in the workforce that Ananth hit upon, it will take a while to get back there. Retraining, probably some movement, people going from one industry to another, from one state to another, and that adjustment process is probably going to make it a bit of a long road back.
Ananth.
So, people talk about all kinds of shapes associated with the recovery with every alphabet. It could well be like Simpson's head, right? Kind of going up and down and up and down. So my own best guess is the kind of recovery we're going to see is going to be more like a Nike check mark, sudden crash and a slow progression, especially as far as unemployment rate's concerned. So I don't think we're going to be there till 2020, late 21, early 22, at the earliest.
The Nike swoosh. Okay, I haven't heard that one. I like it. Noah.
Yeah, I agree with everybody else here. I think, the hope early on was that this would be a short shutdown. We'd be able to restart things very rapidly. But as this has progressed, I think we're seeing more and more of the temporary layoffs becoming permanent. Where also it's not clear that a lot of restaurants and smaller businesses are going to be able to reopen with a substantially reduced scale that'll be profitable. So I think the adjustment process will take quite a bit longer than I'd initially thought.
You guys all agree. That's weird. I think if this was the McLaughlin group, I'd be supposed to say right now, you're wrong. It's 2024. But what do I know? Question from Craig Roach. Does the lockdown blunt much of the short-term economic effect of the stimulus? In other words, we gave people $1,200, they get an increase in their unemployment payments, but of course they can't go on any trips. They're not going to a hotel. What are they going to do with that money? Save it for a while, spend it later? What do you think? Noah, let's go to you.
Yeah, I'll go first. So I didn't think we should have referred to it even as stimulus at this point. It was basically relief. It was paying people or replacing income they would have earned on the job largely. So it was more to pay the rent, to get by on necessities. It's not really, I didn't think it was really about stimulating the economy. And with things shut down, nobody's going to be taking extra vacations or anything. So yeah, we're not going to see a huge fiscal bump from that. It would sustain demand somewhat, but I wouldn't expect big growth coming out of it.
I think we only need one answer there. Mark wonders, are there projections that show the rate of small business failures as the pandemic continues? And I'll throw that up for grabs. Brad, maybe start with you. Do you know anything about that, small business failures or business failures?
We're clearly going into what will be a substantial default cycle. We haven't seen one since the TFT. Neuberger will focus on the larger businesses. The people that I work with that do that work are our global high yield analysts, and for mid-sized to large businesses that are in the public bond and equity markets, our expectation is we have about an 8 or 9% default rate in the high yield market this year. A slightly lower rate next year, with a cumulative default rate that'll get us to about 13 or 14% over 2 years. The good news is that's a better number than we witnessed in the GFC, and it's a number comparable to the downturn of 2000-2001, which was a very mild recession. And a lot of that has to do with the complexion of the markets, balance sheet quality, and the fact that you can borrow at very low rates right now.
I can say something on small businesses, though. There are surveys that about 50% of small businesses say they could last at least, or at most, 2 months without revenue coming in. So the PPP, is designed to help with that. It's supposed to give roughly 2 months, but as things go on, this becomes more and more of an issue.
We have a question from Warren that I'm going to direct to Brad. Warren says, I don't see supply chains recovering very quickly. Sooner or later, that has to affect the stock market. Does Brad agree? And, maybe you've already alluded to that. Not all the stock market is doing that well, not every company. But what are your thoughts on supply chains and whether we've really processed all of that in the market?
Yeah, I think certain companies in certain industries clearly are going to be strongly affected by it. If we talk about things that are going to change permanently, I heard the chairman of McKinsey lay out a few things that McKinsey believes that will change permanently, and one is the approach to supply chains. The term, which has kind of been forgotten, goes back quite a few years now, the death of distance. In other words, you could make anything anywhere. It didn't matter as long as you could make it cheap. It's all about efficiency. That's going out the window. It's about robustness and dependability. And if it costs more, so be it. So that last part, if it costs more, so be it, clearly will affect company profitability, which will clearly affect stock prices. And I think we'll see it in certain industries as being quite profound.
Great. Matthew, obviously trained in economics, wonders how might the pandemic affect Wisconsin's long-term comparative advantage? I love it. We'll give that to one of the academics. Noah, do you want to take the Wisconsin comparative advantage question?
So Wisconsin's comparative advantage, I guess, so our largest sector is manufacturing. Roughly 1 in 7 people in the state is employed in manufacturing. That hasn't been a real employment growth area for a long time. I mean, it had substantial decline from 2000 to 2008. It's bounced back since then. But certainly there had been a trend toward automation already going on, also trade. I would think that this would, in some ways, help accelerate that trend, right? So manufacturers are doing a lot right now to restructure their lines and restructure their shifts so they have less work in close proximity. But I think bringing in more automation is a natural response as well.
You already answered the next question, which was, will social distancing rules lead to jobs being cut as employers automate and change assembly lines that direction? And I think that's probably a strong trend. Question from Richard for the group. With large companies hurting less, is this going to prolong inequalities in the U.S.? And is there anything that can or should be done about that? So how is the pandemic overlaying against the growth in income and wealth inequality that we've seen in the country? I don't know who wants to take that. Ananth, you want to give that a shot?
So that's a good question. And you saw the graph associated with declines in small businesses versus large businesses. You can actually draw a pretty similar looking graph when you arrange declines in wages by current income. And it is the case that inequality is increasing. And there's actually a good bit of evidence to suggest that when you look at previous outbreaks, it tends to increase on average inequality. So there has been a move in the last few decades away from smaller firms to larger firms, and which also has been contributing towards inequality. What can be done about it? I'd say I'm a big fan of making sure that people are skilled. You want to give them the right kind of human capital so that they can get trained. So I think training could go a long way. Other than that, honestly, there are very few other solutions associated with the problem of inequality.
So we get another question from Julia, who, if you were a member of Congress, what would be on your fiscal policy wish list for the next aid package? I suppose it's too late for the herd immunity auction to give out those stimulus checks. But Noah, what do you think? What's on your fiscal policy wish list this time around?
Well, I don't know if it's exactly on my wish list, but one of the big issues right now is going to be aid to states. It's a little sensitive because there's the issue of what do we do with states that we're not so responsible going in, but all states have experienced substantial drops in revenue. They would look to have to cut jobs and services going forward. So I think not bailing out states, but helping to make up some of the revenue loss they've faced would make sense.
Question from Jim. Is it possible that a way out of this will be a new public works program akin to that in the FDR administration? We did bring up the Great Depression earlier, Brad. Do you think we're going to need something like that this time around with the automation and, kind of all the long-term drag that there could be on the labor market?
I've heard the topic brought up a few times, and I think it's a function of persistence. If the recovery's slower and it takes longer, there's a second wave in fall, and more is needed. I think the resolve from central banks and from governments to combat this thing could include something like that. One of my prized possessions is a CCC compass that was given to my grandfather when he was in the Civilian Conservation Corps back in the Great Depression. He was there somewhere in northern Wisconsin, and he spent about 9 months planting trees. And he got meals, he got a roof, and he got a compass. And for him, it was a great thing.
Wow. Yeah, my father went, he left his education in 8th grade in 1930 and moved to a lumber camp in White Lake, Wisconsin, where he spent like the next 8 years of his life. That was different. That was a depression. We are over time. We've already set the record for the longest UW Now live stream. I'll ask one more question, and then I'm going to send out a plea. If Emily Cooper from Sun Prairie, Wisconsin is watching, I need a haircut by next week. So we need to get back on that. Shay wants to know thoughts on the impact of lower government revenue, lower sales tax, noting Cook County is waiving numerous fees, Milwaukee already predicting significant shortfalls. I guess we sort of addressed that when you mentioned, Noah, that we might need to help states out of this. How about municipalities? Same thing, or?
Yeah, I think so. The big difference between states and municipalities and the federal government is most everybody else has a balanced budget rule. So when revenue gets cut, services and jobs get cut, whereas the federal government can issue more debt, as we've been talking about. So in that sense, I think it makes sense to have the federal government do some borrowing that everybody else is not able to do. But yeah, I think it's with the declines in consumption, like Ananth was talking about, that's all going to get passed through into reduced sales tax revenue.
Well, let me just say it was great to bring the three of you together. Brad, I think you should get to know the economics department at Wisconsin better. I'm glad you could join these gentlemen tonight. It's always good to see you. I'll look forward to seeing you somewhere, either on the internet or in Manhattan at the end of June. And Ananth and Noah, thank you for joining us. Any concluding thoughts from anyone tonight? We can go around the horn. Brad, any final sign-off words of optimism?
Great to be here as part of this Badger get-together, and stay safe and best of luck to everyone. And hopefully I do see you this fall somewhere on campus. See you all.
Noah.
Also it was great to join everybody and answer some questions. Again, I'll give a pitch. We've been doing a lot of work on this, crow.wisc.edu. We're updating that regularly, tracking the crisis.
Thank you for doing that. Ananth?
Thanks to you, Mike, and everyone at the foundation for all you do. It's great to be with Badger alums who care so much about the university. I hope everyone stays safe. We get through this, and hope campus reopens in the fall.
Well, one way or another, the pandemic is a time when if you can do anything at all, you can get an education, whether that happens online or in person. And, this is a time when people really have to rally put their best foot forward. It's not easy, but the country has been through a lot worse. So UW-Madison will be open this fall. We don't know what that means yet. And by the way, I'm really pleased that our chancellor is going to wait and take in all the information and make a careful decision, because this isn't anything to mess around with. So anyway, hats off to her, and thanks for joining us tonight. Great to be with Badgers, and hope to see you next Tuesday on Wisconsin.